Hello everybody, I'm Asma Astaf from Higher Colleges of Technology, Sharjah Men's College, and today I'm going in Business Division to explain Accounting 103, Financial Accounting and its core business course. Today we're going to discuss journalizing process and following course learning outcome, apply double entry principles to financial transactions. Actually, this topic is so important topic because most of the students can't differentiate between debit and credit and find it difficult to understand it. So we are going to use different way of illustration that would help you to understand how to write simply the journal entry. To apply double entry principles, we have to go through 4 steps to make it simple. First step, define and interpret the accounting equation and each of its components. We'll start with basic accounting equation. Assets equals liabilities plus owner's equity. Basic accounting equation is the underlying framework for accounting, and assets usually equals liabilities and owner's equity because it's claimed by others, by creditors and owners against assets. Why we are putting liabilities first? Because we should, on liquidation cases, we should pay liabilities first, and then what is left is for owner's equity. Assets definition is resources owned by the business and they have future benefits. Examples: cash, supplies, and equipment. While liabilities, as we said before, it's claims against assets, and it is claims by others other than owner's equity. And example of it: accounts payable, notes payable, salaries, and wages payable. Owner's equity, it's also claims against assets, but by the owners themselves. And sometimes they refer to them as residual equity, and that is because assets minus liabilities equals owner's equity. So what is left is for owners after paying all the debts to liabilities. Owner's equity increases by 2 things: investment by owners and revenues, and also decreases by 2 things: drawings and expenses. Now, step number 2. We are going to expand basic accounting equation, and from it we're going to rewrite it once again to help us to develop the matrix of debit and credit side. So as we said, assets equals liabilities plus owner's equity. If we expand the owner's equity, we will find the 4 components of owner's equity. We have owner's capital and revenues will increase it, and owner's drawings and expenses will decrease it. So increase in owner's equity comes from investments by the owner in the business, and that's what we call it capital. And it increases by revenues as a result from business activities and operations. While decreases in owner's equity comes from drawings by the owners from the business for his personal use, and expenses as a cost of assets consumed or services used in the process of earning revenue. So, as we said, once again, assets equals liabilities plus owner's equity. If we expand owner's equity, we will have that owner's equity equals owner's capital minus owner's drawings, and those are activities by the owners himself, and plus revenues minus expenses, and revenues and expenses are the operations of the business. So if we rewrite the expanded basic equation once again, we will find that assets plus drawings plus expenses from side and equals liabilities plus capital plus revenues in the other side. And we have now to remember the normal balance of each one. So to make it easy, the normal balance for these accounts, 6 accounts, is from the side of assets, drawings, expenses, all of them, their normal balance is debit. While Liabilities, owner's capital, and revenues, their normal balance is credit. Step number 3. We are going to develop debit and credit matrix from basic accounting equation. As you know, we explained before the rewritten basic accounting equation. The normal balance of assets, drawings, and expenses is debit, and the credit side, or the normal balance of liabilities, capital, and revenues is credit. So if we put them in matrix, we have type of accounts, we have 6 accounts. As we explained before, assets, drawings, expenses, the first 3. Their normal balance is debit, that we should always remember. If we want to increase them, we will put them in this at the same as their normal balance, that is debit. If you want to decrease them, we use the credit, that is the opposite of their normal balance. Why? Liabilities, capital, and revenue, their normal balance is credit. So if we want to increase them, we will put them credit as their normal balance. If we want to decrease them, we put them opposite of their normal balance, and that is debit, sorry. Now, step number 4, we're going to analyze economic events and record journal entry using the developed debit and credit matrix. Let's take the transaction on October 1st. We have Arbird invest 10,000 cash in an advertising company called Pioneer Advertising Agency. So we have here the owner is investing in the business, and we have cash. According to the basic accounting equation, cash is an asset, and investment in the business is capital, and it's increasing owner's equity. So if we put in our mind the way of thinking of the matrix, we'll start first to use the type of the account. So cash is an asset, and cash is increasing. So cash is an asset, its normal balance is debit. So if it's increasing, it's also debit. So I'll put it in the entry as debit side. While owner's equity capital is type is owner's equity, owner's capital, its normal balance is credit, and it's increasing, so it's the same as its normal balance. So I put it in credit side. This is the mechanism of writing the entry, and this is the way of thinking that you should always remember. At the beginning it's difficult, but by practice you would cover all the types of transactions that could appear through this kind of quick application. So let's apply the journalizing through entering transaction data in the journal. Number 1, receive investment by the owner. We have on September 1st, fast forward, received 600,000 cash from Hamad Isa as investment in consultation service business. So we have cash, and cash is an asset. Its normal balance, let's remember, it's debit, and cash receiving, it's increasing. So it's the same as its normal balance. So we put it in cash debit by 600,000. Now the credit side is investment by the owner in the business, and the owner is Hamad Isa. So capital, its normal balance is credit, and it's increasing, so I put it in the credit side, same as its normal balance. So credit owner's capital. On September 2nd, fast forward pays 25,000 cash for supplies. We put September 2nd in date, and we have here he pays 25,000 cash for supplies. I will start with the cash. Cash, always try to start it first because it's easier to understand. So we have cash. Cash is an asset as type of account, and its normal balance is debit. So debit, and it's paying, so it's decreasing, so it's opposite its normal balance. So I'll put it in the credit side, so cash credit by 25,000. And now supplies is always asset, so it's asset as a group, and its normal balance is debit, and it's increasing because we are purchasing it. So it would be the same as its normal balance, so it would be debit. So supplies debit by 25,000. On September 6, Fast Forward purchases 71,000 of supplies on credit from Caltech Supply. So we have supplies purchased. We don't have cash here. So we'll start with supplies. Supplies is an asset. Asset, its normal balance is debit. Okay, so we are purchasing, so it's increasing. So it would be the same as its debit balance. So debit, normal balance, debit, supplies, 71,000. And since we are not paying cash, it's on credit, and we have a name of Caltech Supply. Caltech Supply is others. Whenever they are mentioned other than the owner, we call them accounts. On credit means accounts. So accounts, either accounts payable or accounts receivable. Since we are purchasing, we have to pay, and we didn't pay. So it's accounts payable. Now, accounts payable, it's liability. And the liability, it's normal balance. Let's remember, it's credit. And since it's increasing, our liability is increasing, so it would be credit. So same as normal balance. So accounts payable, credit 71,000. On September 8, Fast Forward provides consulting services and immediately collects 42,000 cash. So let's start with cash. We have cash here. Collects cash. Cash is an asset. Its normal balance is debit. So collect means same, means plus, means same as its normal balance. So debit cash, cash is debit, 42,000. And now it's the other side provides consulting services. Since we are talking about consulting company and it's providing consulting services, this is the type of its revenue. So revenue, we consider it as revenue if it's completed, if it's same as its operation, and it's completed or rendered. And they said that they provides consulting services, so it's completed. So it's kind of revenue. Revenue, its normal balance is credit, and it's increasing, so we'll put it as its normal balance, so it's credit, 42,000. Now, payment of expense in cash. On September 10, Fast Forward pays 10,000 cash for September rent. Let's start with cash. Cash is an asset. Its normal balance is debit. Try to remember that always. So they are paying, so cash is decreasing. So it would be the opposite of its normal balance. Its normal balance is debit. The opposite is credit. So we'll put cash credit by 10,000. Now, we are paying for September rent. We are purchasing rent. So if you are purchasing rent and it's only for current period and it doesn't have future benefits, we call it expense. So rent is an expense, and rent as an expense is debit, and our expense is increasing. So once it's increasing, that means it's same as normal balance. So it's debit, rent expense is debit by 10,000. On September 12, Fast Forward provides consulting services of 16,000 on credit, and the customer is billed for these services. Now, here we don't have cash, so we'll start with consulting services. Consulting services is, as we said, it's the revenue of the company because it's completed and it's the same as its operations. So revenue as group, and its normal balance is credit, and it's increasing, and always, by the way, revenues, expenses, and drawings always comes according to their normal balance because they are, we call them temporary accounts, and they always come in journal entry according to their normal balance, just in journal entry. So this is golden rule that you can always follow. So either they are increasing or nothing. So we have consulting services, its revenue, so we'll put it credit. And the debit side is we didn't collect it cash, so we are going to collect it. So we have here customers. The customers, we call them accounts receivable because they are not the owners. and we are going to receive it in the future. Accounts receivable, it's our right, so it's an asset. Debit side, we have debit normal balance, and since it's debit normal balance and it's increasing, we will put it in debit. So accounts receivable, debit 16,000, and consulting revenue 16,000 credit. On September 15, Fast Forward received 16,000 cash from the client billed in transaction number 6. Okay, cash here is asset, normal balance is debit, and if you want to increase it, because collected it would be, yes, debit. So cash debit by 16,000, and accounts receivable, since they are paying and we are collecting from them, we want from them in transaction number 6, 16,000, and they are now paying the full amount of 16,000. That means we don't owe them anything, or we don't have anything from them. Okay, in that case, it would be accounts receivable is an asset, its normal balance is debit, and it's increasing, so it would be the opposite, so it's credit, accounts receivable by 16,000. Now, on September 20, Fast Forward pays Coltech Supply 9,000 cash toward the payable of transaction number 3. So now cash, we'll start with cash. Cash is an asset, its normal balance is debit, and now cash is paying. The payable pays. So it's pays, that means it's decreasing, so it would be credit, correct. So cash credit by 9,000. We are paying for payable and transaction number 3. So it's accounts payable. Accounts payable is liability, and liability is a credit. So if you want to pay for them, it would be decreased. So it would be the opposite, so it would be debit. So debit, accounts payable by 9,000. On September 28, Hamad Isa, the owner, once again, withdrew 2,000 cash from Fast Forward for his personal use. Okay, let's start with cash. Cash is an asset, debit, and here he's withdrawing, that means cash is decreasing. So it's the opposite. It would be cash credit by 2,000. Now the debit side is what? Hamad Isa, and he's withdrawing for his personal use, that means drawings. So drawings is debit, normal balance, if you can remember from the matrix. Debit means that, and it's increasing, so it would be debit also. Okay, 2,000. On September 30, Fast Forward purchases 50,000 of computer equipment from high-tech company and pay 10,000 and the rest on credit. Okay, we have here purchases of 50,000 of computer equipment. Equipment is an asset, it's debit balance, and we are purchasing, so it's debit once again. So from the same as its normal balance. So equipment is 50,000. What's the credit side? We've paid 10,000 cash. So cash is an asset, and its normal balance is debit, and we are paying, so it would decrease, so it would be credit by 10,000. So cash credit by 10,000. And we have here more than one entry or one account. This type of entry, we call it compound entry, when we have more than one account in either side, in debit or credit side. And we here have to balance the entry, and it should be in both sides, debit and credit side, 50,000. So we have equipment 50,000, and we have to make it balance another 40,000. As they said, it's on credit, and we have high-tech company. High-tech company is accounts, and since we are going to pay for them, it's accounts payable. So accounts payable credit by 40,000. To be assured, accounts payable is a liability, always it's a liability, and its normal balance is credit, so we want to increase our liabilities towards high-tech company, so it comes in the credit side. As a summary, we have this poster that shows all the summary or the steps that we go through it. And we have a golden rule that temporary accounts like revenues, expenses, and drawings always journalized at their normal balance. This is common in journal entry only. In other type of accounts, it's not the same. Okay? Thank you.